Okay, great. By way of introduction, my name is Rafael Vidal. I'm one of the founding partners of ProNexus and the lead partner for the Lease Accounting Advisory team. With me, I have Dan Hawthorne, who's a principal of the Lease Advisory and Implementation team. We do have our email addresses on this slide, so feel free to jot those down now in the event you'd like to reach out to us individually after the presentation. Now, before we begin, we do have a few housekeeping items to address. You will be muted for the duration of this presentation, so if you have any questions, please use the Q&A feature at the bottom of the screen. We will answer questions throughout the session, especially towards the end, and there will also be a recorded version of the webinar, which will be sent out to all participants as well. Lastly, we will have a few polling questions throughout the presentation. We ask that you take a few seconds to answer those questions as they come through. Now, for those of you on the call that aren't familiar with ProNexus, ProNexus was founded by two Big Four CPAs from PwC and Deloitte & Touche. The entire leadership team are either CPAs and or former controllers and CFOs. We operate the firm very much like a CPA firm. However, we only perform non-attest services. We have 5 core services, which include consulting, project work, outsourced accounting services, interim and loan staff services. And if you'd like to learn more, please feel free to visit our website. On the home page, on the upper right-hand corner is a link to our case studies, which really gives you a good idea of how we help clients. Now, in terms of experience with leases, for the last 2+ years, ProNexus has been helping companies implement the new lease accounting standard. ProNexus has developed a significant number of IP and tools to streamline the process. In addition, we've invested into lease accounting software to help clients accelerate the implementation. And we've worked with clients that have as low as 10 to thousands of leases as well. Now, as you can see, we have an action-packed agenda for you this morning. Agenda items 1 through 11 will provide you an overview of the new lease accounting standard. Items 12 through 8 will provide you a roadmap on getting started, including keys to success and pitfalls to avoid. Item 19 will provide you software solutions to consider. And finally, we'll wrap up with some recommendations, how we can help, and a little Q&A as well. Now, before we begin, we're going to give you 15 seconds to answer our first polling question. Okay, great. Thank you. So ASC 842 is a challenge. As illustrated in this bar graph, nearly half of the executives are concerned about the implementation. 842 is also pervasive. It affects any client that follows GAAP and has basic operating leases. With the amount of data required to be abstracted and some of the complicated calculations involved, the implementation is complex, especially if you're considering utilizing spreadsheets. Also, with other competing requirements, especially in the past, like revenue recognition, it's sort of been a lower priority for a lot of clients. We are finding, however, there is more work involved implementing the new lease accounting standard than there was with RevRec. So what is the new lease standard? The new lease standard is intended to account for all lease obligations on the financial statements. The end goal really is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities. Now, as many of you have heard, the FASB delayed the date to comply for a year. So for non-public organizations, this moves the requirement to the fiscal year starting after December 15, 2021. And for public nonprofit entities, this moves the requirement to the fiscal year starting after 12/15/2020. Now, with this delay, our biggest fear all along has been that clients are just going to put this off another year and kind of be in the same position as they were. Now, most 1231 private clients will be required to comply in 2022. However, day one, which is processing lease activity the new way, begins on 1/1/22. Now, although 842 may not necessarily be in scope now for reporting purposes, we do recommend you start thinking about and planning for the 842 implementation, especially if you have third parties, for example, your bank, relying on GAAP financials. There's a lot more work involved than people think. Like I mentioned before, more than the RevRec standard if you went through that process. In addition, we don't recommend starting in 2022 because if you do, you'd have to retroactively go back to account for lease account activity differently. Best practices is to try to have all the chart of accounts properly structured and the lease administration process in play before 1/1/22. Now, having said that, some of our privately held and nonprofit clients have already started their implementation projects. There is no penalty to adopt early, and we recommend those companies continue with the implementation efforts. For those that have not adopted, at a minimum, we recommend to get started now with one of two options or a combination thereof. The first option would be to complete the planning, scoping, and assessment phases of the implementation. This is not a lot of work, and it'll really provide your company visibility to what's ahead while identifying the high-risk areas and planning accordingly to meet the compliance deadlines. The second option would be to purchase some lease accounting software, abstract the data elements from your existing leases, and then upload that data into the software. This will allow companies to maintain the lease data in a central repository, estimate what your day one ROU right of use calculation may look like, and then allow for a quick and seamless implementation when the time comes. This would be no different than having fixed asset software for your fixed assets. Now, the lease accounting software is cost effective and can be purchased through ProNexus. For example, if you have 10 leases, it'll cost you no more than $1,500 per year for the subscription license. And for that price, the solution is highly recommended over the alternative of using cumbersome Excel spreadsheets. So what qualifies as a lease? To qualify as a lease under the new standard, it must be a physical asset. You must have the right to control or use the asset, and the asset must be explicitly or implicitly identified. So understanding the new rules. So at a high level, the end goal is really to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities, and some procurement contracts may contain embedded leases. For example, a raw material procurement contract or warehousing agreement. I'll turn it over to Dan now to provide some further insight and comments around embedded leases and procurement contracts.
Thanks, Raphael. Good morning, everyone. Yeah, ASC 842 actually requires you to examine all contracts to determine whether each contract is or contains a lease. A contract has an embedded lease if there is an identifiable asset and the lessee has control of the asset, receives substantially all the economic benefit over a period of time. So I'll give you a couple of examples. We had one client that had warehousing contracts. These were accounted for as service contracts because they did not qualify as an operating lease under 840, but ended up qualifying as an operating lease under 842. So here's the facts of the lease. The warehouse is the identified asset. The lessor did not have the right to service other customers without the lessee's permission, so they had control, and the lessee had 90% or more of the warehouse's capacity, and therefore 90% or more of the economic benefit. We also, so that qualified as an operating lease and had to have an ROU asset and liability placed on the books for all those warehousing agreements that read such. We also have a medical client with agreements to purchase a minimum amount of supplies, and in return, they received related equipment to use those supplies at no cost. So as an example, they have a procurement agreement to purchase leg compression sleeves and accessories for hospital inpatients to prevent blood clots in their legs. The commitment to purchase the supplies included the related compression machines at no cost for the life of the contract and to be returned to the provider at the end of the agreement. On the surface, this looks like a procurement contract for the purchase of medical supplies, but this client now needed to look closer at all these types of contracts to determine if these compression machine type contracts would meet the definition of an ROU asset and liability and be considered an embedded lease, which they did. Also, other leases to think about that may be embedded would be, you may have some dumpsters, you may have a phone system, you may have laptop computers or other computers, IT agreements for ERP systems, GL, your GL system. So there's a lot of areas where you could have embedded contracts. And the standard says you have to review all your agreements to determine whether it's an embedded contract or not.
Thanks,
Back
Dan.
to you, Rob.
Yep. So as you can imagine, there's now additional visibility provided to leases, which will really increase the level of scrutiny from your auditors. So expect to spend more time testing the completeness and accuracy of your lease data. So what is the impact of the new lease standard? Well, with leases transitioning to the balance sheet, CFOs now need to consider the impact to your financial performance metrics, such as working capital. Executive compensation and performance plans may be impacted, and compliance with your debt covenants and your borrowing ability as well. Clients are concerned about potentially violating bank loan covenants under 842, so we highly recommend getting a handle on the potential impact and starting these conversations with your banks as early as possible. Additionally, companies will need to address how much effort will be required to comply and what the administrative burden may be for your accounting teams and other departments such as IT. As a reminder, if you do have any questions, please use the Q&A feature at the bottom of the screen. I'm going to turn it back over to Dan now to discuss the differences between 842 and ASC 840.
Thanks, Ralph. As you probably know, ASC 840 had identified two types of leases: operating and capital leases. Capital leases have been treated as long-term assets and are capitalized to the balance sheet. Operating leases, on the other hand, are recognized as period expenses. These have not been capitalized to the balance sheet, but the balance sheet adjustments may be needed to recognize the expense on a straight line basis. On this slide, we'll look into the new aspects of 842 and how they compare to the old standard. As we've already discussed, the new standard provides a little more clarity on the scope and definition of what qualifies as a lease. But basically, a lease, as we discussed before, is an identified asset that you have control over for a specific period of time. US GAAP, IFRS, and GASB have all come out with new standards. While each group's original attempt was to better align the two, they haven't been aligned in all areas and will require separate accounting. Today's presentation will focus on US GAAP. If you do follow IFRS or GASB or want additional information, we'd be happy to schedule some time to discuss. Keep in mind that we will be starting implementation of GASB webinars and GASB specific software demos in the near future. Under the new standard, accounting for the lessor is relatively unchanged. There are some new classifications, criteria, and modifications that leverage certain guidance in the new RevRec standards. but the new lessor accounting remains similar to the existing standard. Because of this, today's presentation will be focused around the lessee. If you are a lessor, we'd be happy to schedule some time to discuss if you wanted a little refresher. Under the new standard, treatment of capital leases, which are now called finance leases, also remains relatively unchanged. The big change in the new standard is with operating leases, which must now be capitalized on the balance sheet. We have talked about this. We'll talk about the steps in more detail, but here's a quick overview, which covers items 5 through 6 in the current slide. An ROU liability is first recorded and is calculated as the present value of all lease payments. Basically, you're creating a loan amortization schedule. The ROU asset is then calculated to be equal to the initial ROU liability, plus or minus any adjustments, such as upfront payments or existing ASC 840 liabilities or prepaids on rent. In subsequent months, adjustments will be made to these initial balances. The liability will be adjusted like a normal loan amortization based on the cash payments less the calculated interest expense. Straight line expense will be determined based on the total lease payments divided by the number of periods, and the asset amortization will then equal the straight line expense less the current period interest expense. We will also discuss some required changes in the balance sheet, income statement, and cash flow presentations, as well as significant changes with the required disclosures. And those would be the quantitative and qualitative disclosures. And the new standard introduces some new policy elections and practical expedients that you can choose to elect. In some cases, these can help ease the burden of the implementation. In other cases, they become more of a best practice policy election. The following slides will go over items 5 through 9 in more detail. The recognition and measurement of new operating and finance leases, once you have implemented the standard, which we'll refer to that as day one, that Raphael said most people will probably be 1/1/22, and or the day 2 and beyond, which is the continued accounting for the leases beyond that first implementation date. So for both the ROU asset and liabilities, after day 2 and beyond, will be the present value of the lease payments using the discount rate. The asset will be adjusted for any prepayments made or incentives received. For existing operating leases as of day 1, the ROU asset and liability will be the present value of the remaining lease payments. The asset will then be adjusted by any other 840 balances related to the lease, for example, prepaid or deferred rents. For existing capital leases, the ROU liability will increase based on the interest method using the discount rate and will be reduced by the payments made. The ROU asset will generally amortize over a straight line basis, similar to the 840 amortization schedule. Expenses on the income statement generally will be front loaded for financing leases and straight lined for operating leases. Presentation. So the ROU assets can be presented either separately or together with other assets. If presented together with other assets, disclose the line item that includes the ROU assets and their amounts in your footnotes. The finance lease ROU assets must be presented separately from operating lease ROU assets. These assets are subject to the same classification as other non-financial assets. The ROU liability can be presented either separately or together with other liabilities. if presented together with other liabilities, disclose a line item that includes the lease liabilities and their amounts in your footnotes. Finance lease liabilities must be presented separately from operating lease liabilities and are classified as debt. These liabilities are subject to current and non-current classifications similar to other financial liabilities. For leases dominated in a foreign currency where remeasurement into the lessee's functional currency is required, the ROU asset is a non-monetary asset and will be measured at historical cost. It is not affected by the subsequent changes in the exchange rates. On the other hand, the lease liability is a monetary liability and will be remeasured at the period end exchange rates. Changes in the lease liabilities due to changes in the exchange rates will be recognized in profit and loss. As you may have noticed, there's a lot of new accounting treatment and disclosures requirements that have been differentiated between operating and finance leases. Under the new standard, expenses related to finance leases will have two components, interest and amortization, which is consistent with the current capital lease treatment. The income statement presentation will need to be consistent with how the company records similar expenses. A company's interest expense will be determined based on the related loan amortization schedule, and this should be included with other interest expense. The ROU asset will be amortized on a straight line basis, and this expense is included with the company's other depreciation and amortization. Because the amortization expense is fixed and the interest expense decreases over time, again, the finance leases have more upfront expense and the operating leases are straight lined. For operating leases, expenses will be presented in a single operating expense in income from continuing operations. And as we talked about previously, the lease expense will be recognized on a straight line basis over the term of the lease. The lease cost will be recorded on a single line item without any differentiation between the interest and the amortization components. Moving to the statement of cash flows, payments made for finance leases will again be broken into two components. The principal portion of the lease liability will be recorded in financing activities, while the interest portion will be recorded in operating activities. For operating leases, it's another one-line disclosure. The entire lease payment will be recorded with operating activities. Any short or variable lease payments will also be disclosed as a use of operating funds. The new standard also requires non-cash disclosures to reflect the ROU assets obtained in the exchange for new lease liabilities. In addition to the non-cash disclosures, there are certain required quantitative and qualitative disclosures. The qualitative disclosure objective is to ensure the financial statement users to assess the amount, timing, and the uncertainty of cash flows arising from leases. This disclosure should include information about the nature of leases, basis, terms, and conditions on which variable lease payments are determined, extensions, terminations, and purchase options, options that are or are not recognized as part of the ROU asset and lease liabilities, restrictions or covenants imposed by leases, significant assumptions and judgments made, information about leases have not yet commenced but create significant rights and obligation, lease transactions between related parties, and any other significant information you feel important for the financial reader to have. Now, the qualitative disclosures are represented on this table. And an example.
I think you meant quantitative.
Yeah, quantitative. Sorry.
Yeah, no worries.
The quantitative disclosures. The table on the screen provides an example of what your new footnote disclosure may look like. For each period presented, the financial statements, the lessee must disclose the amounts related to the lessee's total lease cost and the cash flows arising from the lease transactions separated by finance and operating leases. This example presented almost exactly as defined in ASC 842, presenting the 10 required elements from the standard. Again, as we previously discussed, your finance lease costs will consist of two components, amortization and interest, while your operating lease costs will be presented as a single amount. A quick view of this list shows that we also have to disclose short-term and variable lease costs, any sublease income, gain or loss on any sales leaseback transaction, operating and finance cash flows, the ROU assets obtained in exchange for new lease liabilities, weighted average of lease terms, and weighted average of discount rates for both operating and finance leases. And as a final recommendation, you will still want to disclose your future obligations for your commitments and contingency footnotes. Ralph, any other comments on this section?
Yeah, thanks, Dan. So in this section of slides, we covered a lot of material, including the comparisons between 840 and 842. We talked about the initial calculations and schedules. We also covered the balance sheet, income statement, and cash flow presentation, as well as the disclosures. So as a reminder, if you have any questions, please use the Q&A feature at the bottom. We're going to give you a few seconds now to ask some questions before Dan jumps in and to talk about the policy elections. Maybe give it
Okay.
five more seconds, Dan.
Okay. Okay, we'll get started. If you do come up with questions, just put them into the presentation and we'll go over them at the end of the webinar. The new standard allows for policy elections to be made for compliance as of day one. Keep in mind that once these have been made, they're not to be changed. Policies can differ by asset class, so you could have a different set of elections for real estate versus equipment. We're not going to discuss all of them in detail, but provide a few examples. An election can be made not to include any leases with terms of 12 months or less in your ROU calculations. You can choose not to show an 842 comparative period, only the current period. Now, these are a couple of examples that are easy choices. Now we're going to go through one of the most complicated ones. So when I first heard about the new lease accounting standard, I thought it would be pretty straightforward. We're just adding an asset and a liability to the balance sheet, right? However, after reading through 200 pages of the standard plus additional literature, I discovered that it was more complex than I would have expected, with some fairly technical guidance. For example, the concept of lease and non-lease components contains some of this guidance. Here's some of the wording from the lease standard. After determining that the contract contains a lease, an entity shall identify the separate lease components within the contract. An entity shall consider the right to use the underlying asset to be a separate lease component, that is, separate from any other lease components of the contract, if both of the following criteria are met. The lessee can benefit from the right of use either on its own or together with other resources that are readily available to the lessee. Now, readily available resources are considered to be goods or services that are sold or leased separately by the lessor or other suppliers, or resources that the lessee already has obtained from the lessor or from other transactions or events. And the right of use is neither highly dependent on nor highly interrelated with other rights to use the underlying assets in the contract. A lessee's right to use the underlying asset is highly dependent on or highly interrelated with another right to use an underlying asset if each right of use significantly affects the other. When the consideration in the contract shall be allocated to each separate lease component and non-lease component, but the components of the contract include only those items or activities that transfer a good or service to the lease. Consequently, the following are not components of the contract and do not receive an allocation of consideration in the contract: administrative tasks, reimbursement, or payment of the lessor's cost. I'm sure to you and to me, this was very confusing. I had to reread it several times. Basically, this is saying that a contract may contain certain items that are considered lease components, certain items that are considered non-lease components, and certain items that are neither. And there's a proper way to handle each of these. For example, with an office lease, you might be required to pay for the office space, for common area maintenance or CAM, real estate taxes, and insurance. In this lease, the office space and the CAM are considered components because they are either an asset or a service. The office space is the lease component, since it's the identifiable asset. The CAM is a non-lease component because this is a service, and use of the office space is not impacted by whether or not this service is performed. For example, if the landlord doesn't cut the grass, plow the driveways in the parking lots, or clean the common area, the tenant can still use the office space. However, taxes and insurance are not components of the lease, since these are neither a good or a service. They are the lessor cost obligations. Therefore, the costs for taxes, insurance must now be allocated between the lease and the non-lease components. It is the costs related to the lease components that are used to calculate the ROU asset and liability. And the CAM costs are ignored in this calculation. This exercise is a lot of effort for the lessee to go through for each lease, especially if they have hundreds of leases. Because of this, the standard allows a practical expedient to ease the burden. Under this expedient, you can elect to combine any lease and non-lease components and forego these standalone calculations. This will ultimately increase your ROU asset and liability calculations, but it can greatly simplify the process. Okay, Ralph, what's next?
Wow, Dan, that was certainly a lot of material there. A couple of tongue twisters as well. The good news is we still have the same number of participants on the call that we started with, and the next topic is going to be what to expect from your audit firm. So many clients have asked us what to expect from their audit firms? And the answer really varies. It's become a little bit more clear now, especially compared to a year or 2 years ago. But the reality is most of the CPA firms, excluding the top 10 or so CPA firms, were kind of trying to figure it out themselves. And looking back, 50% of the public company audits needed additional effort because ASC 842, because of 842, especially those that used spreadsheet solutions like Excel. Now, in this slide, this is a typical lease audit roadmap that's being used by the Big Four CPA firms, and ProNexus has adopted a three-phased approach to accommodate the lease audit roadmap. And this approach really helps our clients prepare the required documentation for the auditors to review so they can gain comfort in the overall calculation. So with that, I'll turn it back over to you, Dan, to walk through the roadmap.
Thanks, Raphael. When implementing the new lease standard, we definitely think that a company should favor a process that aligns with their current business needs. In addition, we think that the company should also remember that their auditors are going to audit the implementation process, its related assumptions, and calculations. For our clients, we have planned our scope of work to match closely with this audit roadmap, knowing that they would need to provide their auditors with this type of information. In whatever approach you take for your implementation, we think that it's good for you to keep this roadmap in mind. At ProNexus, we've developed a three-phase approach in our implementation process: planning and scoping, assessment, and execution. During the first two phases, we address many of the same questions and use a similar approach to the first four steps of the audit roadmap, where we obtain an understanding, assess the risks, develop a preliminary strategy, and test current controls. For example, we start with a lease assessment questionnaire that we review with each of the key stakeholders involved in the client's leasing process. This questionnaire provides us with such information as the client's current procedures, any controls that are in place, their current knowledge of the leasing standards, and their current compliance with ASC 840. Then this questionnaire is coupled with other information received, helps us to gain the preliminary understanding of the overall leasing environment. From this, we will make the initial assessments of any current risks or deficiencies and prepare our work plan accordingly. We will also review the client's general ledger to test whether our understanding matches with their actual process. In a similar way, our execution phase also aligns with the latter steps of this roadmap. For the steps 5 through 8, auditing the prospective period, you will have to perform and document all financial support for implementing ASC 842 for substantive testing. This will include, but not be limited to, review of all contracts to determine if they qualify as an 842 lease or operating or finance, document all data points needed for the calculation of the ROU assets and liabilities, rent expense types, and test for compliance. So the question here is, do we have all our leases and are our data points correct? Determine the discount rate to be used to calculate the present value of the payment streams. How is this rate going to affect the present value of my lease payments? Develop the journal entry and support to recognize the ROU asset and liability to be booked on day one. Develop and document the transaction process to record amortization and rent expense for day 2 and beyond. And again, to review, somebody's asked the question, explain day 1. Day 1 would be your first day of implementation. That also requires you on day one that if you have any balances for 840, so if you did 840 correctly and you had increasing rent payments over a period of time, you should have expensed that rent on a straight line basis. So that would create an accrued rent. So at the end of the lease, that accrued liability would be written off. But when you implement 842, if you have any of those, you have an accrued liability, or if you have a prepaid rent, those would be written off against the amortization of the ROU asset and would be amortized that way. All right, this will include not only day one of the lease, but also new leases, impairments, remeasurements, exercising options, amendments, the list goes on. To accomplish this, you will need to have an understanding of significant accounts and classes of transactions, the processes and controls that you employ to address the completeness of your population of leases, the completeness and accuracy of the lease data used in calculating the transaction adjustments, the calculation of the transaction adjustments, the design and establishment of new accounting policies and procedures to address the accounting and the disclosure requirements under ASC 842 or GASB 87 or IFRS 16. And then finally, completing the 842 audit of procedures, accuracy, and completion of new disclosures as required.
Thanks, Dan. As a reminder, if you have any questions, please use the Q&A feature at the bottom of your screen. Okay, on this slide, there are 6 key roadmap steps to get started. First, you'll need to understand the new rules and what the risks are. Secondly, you'll need to perform an assessment and understand the implementation challenges and risks. Next, you need to staff the project team, which includes identifying a sponsor, a project manager, and assigning a cross-functional team as well. You also need to evaluate the maturity of your current lease program. For example, what systems, processes, and controls are in place. Then you need to define the project scope and strategy. For example, are you just looking to comply, or do you want to implement best in class? And lastly, you'll need to define the budget and timeframes. After completing those 6 steps, you should be in a good position to get started with the implementation. So 5 keys to success for the lease accounting project. First is to build a cross-functional project team. Other than accounting, you're going to want input from other teams such as legal, procurement, IT, real estate departments, and tax, to mention a few. The second key is to pinpoint the issues with technical accounting. Embedded leases and equipment leases are consistently reported to be more challenging there. The third key is collecting the data, which will be the hardest part, and we will cover that piece in a later slide. Next, if you're choosing your software, next is actually choosing your software package carefully. Again, we don't recommend using Excel. It's cumbersome and prone to error. We can help you select and implement software that will meet your requirements. And if you partner with a firm like ours, we have invested in lease accounting software, and the software is cost effective, and you can use it simply to comply with the new standard. Lastly, you'll need to set up a model for the day 2 compliance and beyond. Performing the accounting on an ongoing basis will require processes that keep the leasing data accurate, complete, and up to date. You'll need to establish some policies and controls for lease management. And for day 2 compliance and beyond, you can also partner with a firm like ours and outsource the maintenance of the software and the recurring compliance if you so choose. Some of the most common mistakes include ignoring the non-real estate leases and internal controls and post-implementation. The data for non-real estate leases will be much harder to collect. Most companies don't have a centralized group nor an enterprise application to track them. Post-implementation success requires the development of a repeatable process to consistently maintain accurate and complete lease records to comply on day 2 and beyond. It will also require automating processes for tracking changes to leases. Lastly, you'll need to have some systems, processes, and controls in place that will stand up to an audit as well. Now, before we walk through the workflow plan, we want to cover what companies typically lease and where these leases can be found within an organization. In addition to your real estate leases, here you'll find some of your typical non-real estate leases. For example, your IT and data center equipment, vehicles and manufacturing equipment. As mentioned previously, some of these non-real estate leases could be embedded in procurement contracts as well. Now, this slide illustrates the 11 places to look for leases, which includes anywhere from AP to IT to legal. In some cases, our clients couldn't find some of the leases and we had to go to the lessors as well. Because there are so many different departments involved, it is important to build that cross-functional team for this project. Before we begin the workflow plan, we're going to give you 15 seconds to answer our second polling question. Okay, thank you for that. All right, this schedule represents our typical workflow plan that we use when implementing the new standard, and this aligns with what to expect from your audit firm as discussed previously. One of your first tasks will be to perform an assessment and obtain an understanding of your current state lease processes and the relevant procedures, data, and systems involved. The assessment will allow you to determine the size and scope of the overall work effort. For lease accounting projects, the complexity will not necessarily correlate with the size of the company or their annual revenues. Instead, it's really a function of the complexity of the client's lease portfolio and the maturity or immaturity of the related processes. And we have a survey, a questionnaire that we use as a starting point, and we also speak with the lease stakeholders that are part of the overall project team. And during this process, there may be some opportunities to identify savings as well by not only solving your lease accounting problem, but enabling better lease administration. The next task is to perform an enterprise-wide lease census. Our goal here is really to build a master list of all leases, including the embedded leases. We just reviewed some of the assets companies typically lease and where to look for them. And we have a checklist that we go through to ensure completeness. We document the testing performed so this can be provided to our clients' auditors. And as we perform our review, there are several places to look and questions to ask to build the census. Some of the questions we ask to build the census occurs during the assessment phase, and key questions includes, who negotiates the leases, who manages the lease assets, and who reports on those leases, to name a few. Another task in the workflow plan is to define the project strategy. On one hand, your leasing program may be mature and you decide that the strategy is just to comply. On the other hand, you may want to do more than just comply. There may be some significant savings opportunities and you decide that the strategy is to transform your lease administration process. So as you're performing the work, the end goal is really to design the future state, which applies to day 2 and beyond compliance. Here you want to design a business process and systems for the future. Now, the 5th task here is to determine how long the project will take, the resources required, and estimating the overall budget. Number 6 and 7 on this slide, collecting the lease accounting data coupled with the contract review is the most time-consuming aspect of the project. We have a list of 100 data elements that we recommend clients abstract from their leases. With some of our clients that are implementing a more robust program, we've seen as many as 180 data elements collected. Now let's skip ahead to slide 24 for a minute. Starting from the lease census, this schedule really summarizes the different activities required to collecting your lease accounting data. The information is split between 2 phases, the planning and analysis phase and the data aggregation and upload phase. Now let's go back to the workflow plan to discuss the contract review process. In terms of labor effort, on average, it takes 2 to 4 hours per lease on the low end to 6 to 8 hours on the high end to review contracts. I'll also tell you, if you have people that don't have much experience reviewing contracts and understanding the legal language, it could take those folks up to twice amount of time than experienced professionals. For example, some of the managers on our team can review contracts on average 1.5 times faster than some of our seniors on our team. We already covered policy elections in a previous slide, but I would add that in some cases, clients will ask us to prepare pro forma analysis to support some of the policy election decisions. Now, for selecting a software vendor, let's go to slide 25. So as mentioned previously, we would highly recommend considering lease software solutions. Our software is the only lease accounting software made by former CPA firm auditors. The software was named the best lease accounting software by digital.com, and it was rated #1 easiest and most accurate lease accounting software on the market out of, I think, 80 software solutions that are out there. Our experience, again, using Excel to manage the ongoing compliance is difficult and will increase your risk. For example, there's no segregation of duties, there's limited access controls, inadequate audit trails, change reporting and version control is difficult, and it really becomes tedious and a manual process when you're looking at the contract remeasurements, modifications, and adjustments. We have the lease accounting software on the cloud that we use to implement the new standard, and it complies with FASB, IFRS, and GASB. And this slide here illustrates some of the essential innovative features the software offers. The software provides you unlimited users, and you're only charged based on the number of leases, which is a nice feature. It is cloud-based. It has a centralized repository for all your leases and supporting documentation. It has a lease classification, lease term, and embedded lease wizard to guide your staff with proper accounting of leases. And the software is designed to comply with the new standard by providing you all the reporting required, including the amortization schedules, the journal entries, and automated footnote disclosures as well. Lastly, it does have an audit trail feature, and you're able to provide your auditors access to the software so they can perform their testing at their leisure. If you are interested in software, we can send you an on-demand recording of our demo, and we do have an upcoming webinar in June as well. We're going to give you 15 seconds to answer our third polling question now. Okay, wonderful, thank you. Okay, excellent. So we've made some recommendations throughout the presentation. However, this slide summarizes them all in one location. Our first recommendation is to make good policy elections. Next, get an early start on understanding the impact on the banking relationship and check in with your banks on this as well. The third is to allow sufficient time to implement. Next is to choose a software solution in place of spreadsheets. Next, partner with a firm to provide advice, supplement your team, or even outsource. Lastly, take action as soon as feasible. It's important to assess the size and complexity of your lease portfolio, the strength and current centralization of your process for leases, and the scope of your implementation process. As with any standard change, it's important to get an early handle on it and get the experts involved when needed to provide the best and most prudent advice. The new lease standard is subjective and open to interpretation, and having some supporting documentation for the policy elections and the confidence in the calculations will make for a smoother implementation. If you feel like you're behind or you want an independent, objective look to confirm that you're on track or you have some gaps you'd like to address, ProNexus can help you. We've been working on this for the last 2+ years with publicly traded clients, and our privately held and nonprofit clients have been starting already this past year. We've invested in software and developed IP and tools that can help you accelerate your implementation as well. We have the assessments available. We have the project governance and project team templates. We also have the validation checklist as well for completeness purposes. We have the contract review checklist and, of course, the accounting software that is available. If you're looking to partner with a firm, ProNexus can help you in a variety of ways. We can help you with education by understanding the new rules. We can also help you with roadmap development, planning and scoping, helping you with the current state assessment and gap analysis, help you with software selection, people, processes, and controls. And in some cases, sometimes our larger clients were using some of their own people to put on the project, and they would come to us to backfill some of the day-to-day responsibilities as well. And I think I mentioned before, if you're interested in either a co-source or an outsourcing model for the ongoing compliance with Day 2 and beyond, that's another area that we can also help. Let's see. The last thing I would mention about that is, how you structure your resources, tools, and expertise to implement the new standard can vary. We can sit down with you and strategize and discuss your requirements and some of the options that might be available to your organization. We've come up with some creative ways to help clients come up with a cost-effective solution to handle their implementation. Well, I want to thank everyone for their questions. We have picked a few to respond to today. Looks like we have a few minutes left. So if we can't get to all the questions, please feel free to reach out to us after the webinar. Just as a reminder, if you are interested in software, we can send you an on-demand recording of our demo. We will be resuming our lease webinars in 2021, the rest of this year, including GASB and ASC implementation and software demos for both. And I want to thank everyone for joining us today. Let's go ahead and address one of these questions.
All right, Raphael, we kind of covered this first question. So please explain the day one adjustment. And we'll just review that real quick again. So any of the accounts, for example, prepaid, deferred, accrued liabilities, capitalized costs for costs related to the lease that you're amortizing over a certain period of time, or any incentives you got up front that you're amortizing, those would all be written off on day one and kind of consumed by your ROU asset. The numbers really aren't going to change at the end of the day. They're just going to be kept in one bucket. We also have a question here that somebody asked. We have multi-year leases with our tenants that lease our building space from us. Do we need to show the leases on our balance sheet? Well, if I understand the question correctly, I'm going to assume that you own the building and you don't lease the building yourself, and that you have the ownership of the building properly recorded on your books. And if you are the lessor and you're properly following 840, that would not create an ROU asset or liability on your books. So hopefully that answers that question. The only time that you have to create an ROU asset or liability on your books is if you're the lessee. Okay. Well, I think that does it. Or do
I think Dan, there's one more. We have maybe time for one more here.
Okay. All right.
All right. It says, could you provide more details on the reporting tool included in the ProNexus lease accounting software? You want to take that one on, Dan?
Yeah, so the reporting tool has Excel or downloaded from the system in an Excel format, and it includes journal entries, amortization schedules, ASC 842, GASB 87, IFRS footnote disclosures, which you kind of saw the 842 in the presentation. All lease data points that are entered into the system, quantitative and qualitative. So basically a description of your lease and your variable lease payments, your CAM, or your actual rent expense streams. And if you want more detail on that, and these reports, I should add that they run very easily. So you can, there's probably 8 or 9 fields that you can select the leases from. So you can run it on one lease, or you can run it on all your leases, or you can run it by one company or one location and run these reports. And it does have a date field, so you can run it for 1 year, for 1 quarter, for 1 month, or for the total lease. And that also includes the journal entries. You can run the journal entries for a month or for a year. And just a reminder that on the 22nd of June, we'll be going through our lease accounting software demo, where we'll walk through probably at least 95% of what the tool can do.
Excellent. Thanks, Dan. And that's it for our time today. So I want to thank you again for joining us today. We hope you found this information valuable, and feel free to reach out to us if you have any questions. And please enjoy the wonderful weather that we're having out there this week. Thank you all, and enjoy the rest of your week. Bye now.